Welcome to the Deep Dive. Today, we're really digging into the source material on Troy Mire, specifically his mastery of private capital in California real estate.
Right. It's a pretty demanding market out there.
Exactly. So our mission today is to get past the resume. We want to unpack the actual mechanisms, the strategy, the insights from experience, and really understand why serious investors trust his team with these high-stakes deals.
Yeah, it's almost like a case study in vertical integration, isn't it? And we're not just talking about someone who pushes paper.
No.
We're looking at someone who spent, over 20 years mastering every single layer, residential, investment, and the crucial part, lending. That 20-year mark, it's not just time served.
Right, it means something more.
It signifies navigating, every recent market cycle. The booms, the busts, all the legislative shifts. He's seen it.
That suggests a level of, let's say, preparedness that's not typical. Let's zero in on the credentials for a second. The sources highlight dual licenses, real estate broker, and mortgage. Why is that combo so important? How does it change things practically with private capital?
Well, think about it. Most people work in silos, right? A broker spots the deal. A lender assesses the risk structure.
Separate jobs.
Totally separate. Holding both licenses gives Troy Mire this inside-out perspective on financing. He's not just matching money to a property. He's underwriting the property's potential value while structuring the capital at the same time.
Okay, so it speeds things up.
Massively.
Yeah.
Faster due diligence, and often it means spotting these structural opportunities others just don't see because they don't have that holistic view. Collateral and debt architecture together.
I appreciate that clarity. That makes sense. Let's talk about where that foundation was built. The sources mention some pretty intense early operational depth.
Oh, yeah. What really stands out is that early career stage owning and operating a Century 21 office. I mean, that's not passive experience. That's running the P&L, managing agents, handling hundreds of transactions, dealing with client crises, all through massive market swings.
Wow.
That kind of intense hands-on experience, that defines the brand today. It's all about clarity and precision.
So he wasn't just watching the market cycles. He was running a business that absolutely depended on surviving them.
Exactly. And that experience translates directly into what the Troy Mire team promises.
Yeah.
Real solutions when timing and structure are absolutely make or break.
And this expertise, we know, it's laser focused on Southern California.
Precisely. The focus has to be specific because that market demands it. Investors rely on their direction in Los Angeles, Orange, Riverside, San Bernardino, and Ventura counties.
5 distinct economies, really.
Right. And staying relevant across all 5, which are often hyper-competitive, needs an incredible amount of current local data.
Yeah.
And speed. You need speed.
Okay, this is where it gets really interesting, especially for maybe the more technical investor listening. When we talk solutions, we have to look at the specific high-risk, complex situations he navigates. This isn't your standard mortgage stuff.
Not at all. This is highly specialized problem solving. It's where he really earned that reputation.
Okay, like what?
Well, the source materials list things like fix and flip projects, speed is everything there,
Yeah.
Construction loans, obviously, but also the really tough stuff. Rescue and bankruptcy financing, even default recoveries.
Okay, wait. Rescue and bankruptcy financing. That implies the client's already in deep trouble. Why private capital through this team instead of, say, a traditional bank in those cases?
Well, traditional banks, they're constrained, right?
Yes.
They have regulations. They look backwards at credit history, compliance checklists.
Slows things down.
Terribly. In a bankruptcy or default, time is absolutely critical. And the risk profile is just. It's non-standard. Private capital, especially when structured by someone who truly understands the actual property value after a restructure, can move incredibly fast.
And accept different terms.
Exactly. They can accept collateral positions a bank wouldn't touch, provide the immediate liquidity needed to stabilize things, or, exit before the asset value just evaporates.
Let's dig into one of the really tricky areas you mentioned. Financing deals with second and third positions. That's layering debt behind existing lenders. Why take that risk? And how do you even justify it analytically?
It really comes down to yield and timing, but you absolutely cannot step into those positions without surgical certainty on your collateral coverage. Especially a third position, the risk ramps up exponentially.
So what makes it viable?
2 main things. First, the analysis has to show a much lower loan-to-value, or LTV, on those senior debts than you might think. There has to be a significant equity cushion left for that junior loan.
Okay.
Second, and this is key, a hyper-aggressive, predefined exit strategy. Usually we're talking 6 to 12 months, max. Get in, get out, pay off the debt before the market can shift too much. Private capital speed makes that tight window possible.
That shift from typical bank thinking, focusing on LTV, to this time-based exit strategy, that's really structured risk, isn't it? Which brings us nicely to the core methodology. How does the team structure their analysis to enable this kind of high-speed, confident action?
The whole approach seems built to cut out hesitation. It focuses relentlessly on 3 pillars: defining the value clearly, assessing the risk rigorously, and engineering a very definite exit strategy.
Okay, value, risk, exit.
Right. And crucially, they use internal proprietary models. These analyze things banks just ignore, like how long local permitting might take or forecasting specific material costs for construction. If you can predict those bureaucratic delays, you're actually cutting your risk.
That's a powerful angle. But let's talk about the really unique edge, the thing that seems to separate them, that contractor's understanding. The sources say the expertise goes beyond the deal structure into property condition, cost control. Can you give a concrete example of how that physical knowledge changes a deal's financial structure?
Yeah, this is really the key differentiator. Okay, imagine an investor finds a distressed property, perfect for a fix and flip. But the inspection report flags potential foundation issues.
Right.
Major red flag for a bank.
Right. A conventional lender might just walk away or drastically cut the loan.
Exactly. The deal dies. But with that contractor's insight, they can immediately translate that physical risk into a definable fixed cost.
No.
They can estimate, say, okay, this foundation repair needs $80,000 and will take 6 weeks. Then they can structure the private loan to include that specific cost and timeline, setting clear milestones. It's not just speculating about the problem.
So they build the solution cost into the loan structure.
Precisely. The investor gets the capital they need, including for the repairs, right away. And the lender, the capital provider, has a mitigated, known risk profile, not an open-ended question mark.
So that hands-on physical knowledge doesn't just help the borrower, the investor, it actually lowers the perceived risk for the capital provider too, which could mean better terms, maybe higher leverage.
You got it.
Yeah.
It allows them to see genuine opportunity where competitors just see overwhelming construction risk and potential budget blowouts. This synthesis, this blend, lets their clients move way faster and, frankly, safer. It bridges that huge due diligence gap that kills so many fast-moving deals.
It sounds incredibly disciplined. The core philosophy then must be purely data-driven, right? Avoiding speculation.
That's absolutely the commitment you see repeated. He doesn't speculate. The focus is educate, structure, deliver, period. Everything is grounded in that data, yes, but also in 2 decades of real-world experience across all 3 legs of the stool: brokerage, lending, and the physical structure side. That provides the confidence investors need, especially now as the California market keeps shifting.
So this deep dive, it really shows that true mastery in this private capital space, especially in California, it's about synthesizing different kinds of expertise. It's running the operational side through every market cycle.
Right, the Century 21 experience.
Holding those dual licenses to understand both the deal and the debt.
The inside-out view.
And then uniquely blending that contractor-level physical knowledge with sophisticated financial structuring, all focused on those specific SoCal counties.
Exactly, and that synthesis, that's really the key takeaway for you, listener. Think about those high-risk scenarios we talked about: bankruptcy recovery, tricky construction finance, those second and third positions. How does integrating the financing know-how, the mortgage license, with the physical structure know-how, that contractor's eye, how does that change how you might view risk mitigation in real estate investing?
It's a different lens entirely.
It moves the goalposts, doesn't it? From just reacting to the market to being analytically proactive.
That's a great point to end on. If you're an investor looking to potentially apply this kind of structured insight to your next project, you can connect directly with the Troy Mire team. Their website is troymireteam.com.